What is up, guys? Imagine being able to retire comfortably one day, travel the world, and live fully without having to stress about money. Well, investing is the secret to make that dream come true, and the earlier you start, the sooner you get to lounge on a yacht in the Mediterranean Sea, sipping champagne while watching the color of the sunset dance over the sea.
School systems teach us nothing about money. Nothing. It's pathetic. They have financial literacy courses today. Well, that's not financial education. It's really pathetic.
And so the first step, obviously, is understanding that you're not going to earn your way to a fortune. Even people that do that don't usually keep it. You got to make money while you sleep. And the only way to do that is understand compounding. So if a child is a young person, 19, 20 years old, puts aside $50 a week, they put it in the market over historical returns, it's $2.2 million. But you might say, I'm not 19. So we created a chart here for you, if you want to throw it up, that you should know what your number is. If you're 20, you need $3,000 a year. If you're 40, you need $15,000 a year. If you're 50, you got to put away $37,000 a year to have $1 million at a 7% return. So what I really want to do in this book was give people an unshakable feeling that no matter how much volatility there is, there are truths about the market you have to know, and they don't vary. And if you understand those, that's the people that win the game.
So if you're ready to take the step towards financial independence, this is for you. I'll cover everything you need to know as a beginner. So sit back, relax, grab a drink, and prepare to have your world turned upside down. Welcome to the world of the stock market, a place where fortunes are made and unfortunately lost. A field of greed and corruption, but still a place of opportunity. The stock market is a marketplace where publicly traded companies' shares are bought and sold. It is the place where companies go to raise money by issuing shares of stock to the public. It is basically divided into two sections. The primary market is where companies first issue shares to the public, such as IPO day, and the secondary market. This is where the majority of stock trading takes place between investors. It is considered to be a reflection of a country's economic health. Many countries around the world have stock markets. Some of them include the United States, Canada, China, India, Australia, and so on. The most well-known stock markets in the world are the New York Stock Exchange, which is the largest exchange in the world, and the NASDAQ, the second largest exchange. They both have the same trading hours, 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. They both offer a wide range of trading options. Some of these are equity options. These are based on individual stocks, index options such as the S&P 500, and plenty more. Finally, they're both located in New York City, located on 11 Wall Street in the financial district of Manhattan. Just in case you're wondering, what is a stockbroker? A stockbroker is a professional who buys and sells securities on behalf of their clients. Most brokers are usually large brokerage firms like TD Ameritrade, Webull, SoFi, and so many others. Some of their clients include individuals like you and me, wealthy individuals with tons of money, such as your Bill Gates and the South African Elon Musk, and huge institutions like banks and investment firms. They are very experienced and knowledgeable, so they make their money by offering advice and portfolio management services for their clients, usually to wealthy investors in the forms of fees, interest, and so on. To become a stockbroker, you will need to be licensed. This typically requires passing a series of exams that are required by FINRA, an organization that is responsible for regulating and overseeing brokerage firms and their registered representatives, basically the people that work for them. So why do companies go public? Going public or having an IPO is like a big party for a company. Companies go public for many reasons. One of the most common reasons is to raise capital. There are two ways to fund a company: equity or debt. In this scenario, they issue equity, which allows a company to raise money by issuing these shares to the public. Investors get shares of stock, and the company gets money so that they can use the money to finance their operations, their business, their growth, their expansion, research and development, and so on. Just like you would most likely need money to start a business and scale a business, companies also need money in order to do the same thing. You can call it OPM, other people's money. Another reason companies go public is so that early investors, like venture capitalists who invested early during the startup phase, can exit their investment. This is usually done at a premium, hopefully with a healthy return on investment. For example, venture capitalist firm XL Partners invested $12.7 million in Facebook during its startup phase. Back in 2005, by 2012, when Facebook went public, that investment was worth $9 billion. Talk about a payday. It's important to note there are plenty of other reasons to go public, so understand that these reasons can vary depending on the company's objectives. What are stocks? Stocks, also known as equities, represent a share and ownership of a public traded company. They allow common people to participate in the stock market and potentially profit. All stocks have ticker symbols, which are a combination of letters used to identify different stocks. For example, the company Apple ticker symbol is AAPL. When a regular person like you and I buy a stock, we become a shareholder in that company. Since we are now considered owners, we have the opportunity to earn or lose money based on how the company performs. On top of that, by holding stock in a company, you're allowed voting rights. These rights allow you to vote on matters related to major acquisitions, other business decisions that the company wants to take, such as merging, purchasing of another company, etc. The list can go on and on. To vote, you would need to attend a shareholder meeting. 99.9% of people never do. Furthermore, stock prices fluctuate daily. This could be for a variety of reasons. Some include company news comes out. This could be good or bad. Market and economic conditions change, and so on. The main objective of this game for investors and traders is to try and get ahead of that information so that they can make a profit. You essentially do this by buying low and selling high. So it's important that you invest in companies that you believe in because their success will ultimately determine your success. Since there are a lot of factors that determine the value of the stock, like I already mentioned, like company performance, economic conditions, and global events, it's important to be well researched before pulling the trigger on a company or a stock. Be warned, things can get ugly in the stock market. Things can get very unpredictable, but with the right research and strategies, the rewards can be life-changing. What are ETFs? Exchange-traded funds, known as ETFs, are a basket of securities, like a group of stocks, that let investors invest in a lot of securities all at once. They usually track some sector, like the banking sector. They do this by holding on to various stocks of different banks. For example, a banking ETF will hold on to shares of stocks in JP Morgan, Bank of America, Wells Fargo, all in one basket. An ETF can hold hundreds to thousands of stocks. The main benefits of ETFs is that they offer diversification, which can help you minimize risk. The idea is that by investing in a variety of securities, your risks are spread out compared to just being invested in one stock. ETF shares can be bought and sold on the stock exchange, just like stocks, and their prices will also fluctuate throughout the trading day. Some popular ETFs include QQQ, VOO, and SPY. What are dividends? Dividends are like the cherry on top of a sundae. Dividends are payments made by a company to its shareholders. These payments are usually made in the form of cash, but can sometimes also be paid out in the form of extra shares of stock. By being a shareholder in a company that pays dividends, you are essentially helping fund that company's growth. So as a way of thanking you for investing in them, they will take some cash from their earnings and deposit it into your account. These payments are usually paid out on a quarterly basis, so 4 times a year. So if you're looking for a steady stream of income, dividend investing can be a source of that income for you. Why invest in stocks? Investing in the stock market is a great way to grow your wealth and secure your future. One of the main reasons people invest in the stock market is so that their money will work for them rather than you having to work for your money. Sounds a little confusing, but it just means you can effectively get what you need, which is money, by letting your money make more of it. Another reason why people invest in the stock market is so that they can plan and save for retirement. Investing allows people to save more money at a quicker rate when compared to just taking part of your paycheck and putting it aside. Essentially, by avoiding the latter, you allow compound interest to work for you, so that come retirement, you will have a big bag of money to enjoy. With a proven track record of providing higher returns than just leaving your money aside or in a savings account, it would be very foolish not to invest in the stock market. In fact, over the last 30 years, the S&P 500 has had an average annual return of 10%. Additionally, it serves as a way to protect yourself from inflation. As inflation rises, your money will continue to buy you less and less, but by investing in stocks, you can hedge that decrease in your money's purchasing power. After taking everything into account, the most thrilling aspect comes from building your investment portfolio and watching it grow over time. It is one of the coolest and rewarding things you can do, and something that your future self will be grateful for. As we wrap up on this video on investing for beginners, it's important to remember that investing in the stock market can be a great way to grow your wealth. It's also important to understand that investing does come with some level of risk, but by learning about the basics of investing and continuously educating yourself about personal finance, the stock market, and most importantly, subscribing to this channel, you can help minimize that risk, allowing you to see greater success. So set goals, create a plan, and understand that investing, just like your personal growth, is a lifelong process, and the earlier you start, the better. Thanks for watching. Good luck in your investing journey. Make sure you hit that subscribe button on your way out, and I'll catch you guys on the Mediterranean Sea.